Right now, global financial markets are standing at a turning point. This is not a normal economic phase. This is a moment of uncertainty. Across the world, investors are becoming cautious. Not because of one headline, but because trust is slowly weakening. Trust in economic stability, trust in long-term growth, trust in financial systems. Global debt continues to rise. Governments are borrowing more. Corporations are refinancing at higher costs, and consumers are still struggling with inflation. Central banks are under pressure. If they keep interest rates high, economic growth slows. If they cut rates too early, inflation returns. This creates instability. Bond markets are reacting first. Yields are moving unpredictably. Long-term confidence is fading, and investors are demanding more protection. When bond markets become unstable, other markets usually follow. Currencies are sending warning signs. The US dollar remains strong, but cracks are beginning to appear. Trade tensions, rising deficits, and geopolitical uncertainty are slowly weakening confidence. Other major currencies are also volatile. This tells us something important. There is no perfect, safe currency anymore. Stock markets are still holding up, but optimism is fading. Earnings growth is slowing. Costs are rising, and expectations are being adjusted. Markets are calm on the surface, but pressure is building underneath. This is often how major market shifts begin. Not with panic, but with silence. Capital is quietly moving. Investors are reducing risk. Cash positions are increasing. Speculation is slowing down. This is preparation. Smart money moves early, quietly, without headlines. Retail investors usually react later. Global trade is also changing. Supply chains are becoming less efficient. Protectionist policies are increasing, and costs are rising. This puts more pressure on inflation and slows global growth. The biggest risk right now is not a single event. It is accumulated stress. Small problems adding up. Policy mistakes, geopolitical tension, market overconfidence. Any one of these can act as a trigger, and when that happens, markets will react quickly. This is not a time for fear, but it is a time for awareness, because financial systems do not break suddenly, they weaken quietly, and those who understand the signs early are never surprised later. As global markets move forward, one thing is becoming clear. This cycle is no longer driven by growth, it is driven by risk management. Investors are not asking how fast economies can expand. They are asking how fragile the system has become. Liquidity is changing. Money is no longer freely flowing across all markets. It is becoming selective, careful, defensive. This is a critical shift. In strong markets, liquidity is everywhere. In stressed markets, liquidity disappears suddenly. We are now in the transition phase. Central banks remain at the center of this story. Their tools are limited, their decisions are delayed, and their credibility is under constant pressure. Markets are questioning whether policymakers can control outcomes or simply react to problems after they appear. This uncertainty increases volatility. Even small statements now move markets. Even minor data releases create sharp reactions. That is a sign of sensitivity. Bond markets continue to send warnings. Yield curves remain unstable. Long-term debt confidence is weak, and refinancing risks are rising. When debt becomes expensive, growth slows. When growth slows, earnings decline. This is how cycles turn. Equity markets are adjusting quietly. Valuations are being questioned. Risk premiums are rising, and optimism is becoming cautious. This is not panic selling. This is repositioning. Investors are preparing for outcomes they once believed were unlikely. Global trade is another pressure point. Tariff discussions are returning. Strategic competition is increasing, and supply chains are becoming regional instead of global. This raises costs, reduces efficiency, and fuels inflation pressure. Inflation may no longer be rising rapidly, but it is not gone. Persistent inflation is dangerous. It erodes purchasing power slowly, it distorts investment decisions, and it weakens long-term confidence. Currency markets reflect this stress. Competitive devaluations are becoming more common. stability is harder to maintain, and currency volatility is increasing. When currencies lose stability, capital looks for alternatives. This is why investors are becoming more defensive. Cash is no longer ignored. Risk exposure is being reduced. Hedging is increasing. These are not emotional decisions. They are strategic. The most important thing to understand is this: major financial shifts do not announce themselves. They developed quietly, gradually. Then, suddenly, most people realize what is happening only after markets have already moved. Right now, we are still in the early awareness stage. Fear has not arrived yet, but confidence is weakening. That is how every major transition begins. In part 3, we will focus on market volatility and mispricing, where stress could appear next, and why sudden moves catch investors off guard. Because the next phase of this cycle will reward preparation and punish complacency. As we move deeper into this cycle, volatility is becoming the defining feature of global markets. Equities, bonds, and currencies are all reacting more sharply to news, data releases, and policy statements than ever before. This is not chaos. This is sensitivity. Markets are pricing in uncertainty more aggressively than growth. Even small surprises now trigger outsized reactions. Investors who are unprepared will feel it first, and they will feel it hardest. Let's talk about market For months, valuations have assumed stability. Low volatility, central bank control. Now those assumptions are breaking down. When markets misprice risk, they create opportunities and dangers at the same time. Some sectors are becoming overvalued. Others are undervalued, and the disconnect between price and reality is widening. Liquidity stress is appearing in select areas. Short-term funding is becoming more expensive. Spreads between borrowing costs are widening, and the cost of hedging risk is rising sharply. This is a critical warning. When liquidity tightens, even large institutions can face stress, and volatility spreads quickly. Currency markets are particularly sensitive. The US dollar, euro, yen, and emerging market currencies are all showing unusual swings. These movements are not random. They reflect uncertainty about policy, trade, and economic strength. Investors are reacting faster. Some are seeking safe haven assets. Others are reducing leverage. Capital rotation is happening quietly. Money is moving from higher risk sectors to lower risk sectors, from volatile assets to stable income-producing assets, from growth-focused portfolios to defensive allocations. The pace of this rotation is accelerating, and the speed of adjustment is catching many by surprise. Equity markets remain fragile. Earnings expectations are being lowered. Margins are under pressure, and investor sentiment is cautious. The danger is not collapse. The danger is sudden repricing. Small shocks, once absorbed easily, now have larger effects. Geopolitical events, central bank signals, and economic data all carry more weight than before. The pattern is clear. Markets move quietly. 10. Suddenly then. Unpredictably, those who recognize stress early can act before losses occur. Those who wait for confirmation will often react too late. Global trade remains a stress factor. Supply chains are fragmenting. Tariffs, protectionist policies, and geopolitical tensions create uncertainty for pricing, delivery, and investment decisions. This adds to market sensitivity. Capital flow, liquidity, currency, stability, and trade pressures are all converging at the same time. This is the essence of the current financial environment. Calculated stress with hidden risk. Part 4 will cover long-term outlook, where major risks might appear next. How investors can prepare for sudden shifts and what to watch in the coming months. Because preparation now can prevent panic later. Now we arrive at the final phase of this cycle. The key question is, what happens next, and how should investors prepare? The first point to understand is this: financial systems do not fail overnight. They weaken quietly, accumulate stress, and only later do small events trigger major reactions. We are entering that quiet accumulation phase. Liquidity will continue to fluctuate. Bond yields will remain unpredictable. Equity markets will react to even minor surprises. Currency volatility will stay elevated. This is not a sign of panic. It is a sign that the system is adjusting to uncertainty. The second point. Capital rotation will define the next months. Investors are moving from high-risk, high-volatility sectors to defensive assets. Cash is rising. Hedging strategies are increasing. And safe haven instruments are gaining attention. Those who recognize this early will protect themselves from the worst effects of sudden market moves. Global trade is another critical factor. Supply chains are becoming regional. Tariffs and protectionist policies are returning. And uncertainty around geopolitical tensions is rising. All of these factors increase cost pressures, reduce growth, and create long-term market volatility. The third point, do not rely on a single signal. The markets are complex. Multiple stress factors, policy, currency, debt, trade, are interacting simultaneously. Successful investors monitor signals, not headlines. They prepare for multiple scenarios: gradual adjustment, sudden correction, or sustained volatility. The fourth point. Timing is difficult. Markets will surprise most participants. The best strategy is preparedness, not prediction. Have clear rules. Know where risk is accumulating, and act consistently, not emotionally. Finally, look at the long-term picture. Economic cycles repeat. Crises are temporary. Opportunities exist even in unstable conditions. The difference between those who succeed and those who panic is awareness and preparation. This is not fear-mongering. This is market reality. The signals are visible today. Liquidity shifts, currency stress, debt pressure, and trade uncertainty. Those who recognize them now will be ready when the markets move sharply, because the next phase is coming. It will reward caution, strategy, and insight. It will punish complacency, overconfidence, and ignorance. Stay observant, stay prepared, and watch the markets carefully. The quiet before the storm is the time to position wisely, because when the storm hits, it hits fast.